Okay, thank you everyone. Thank you for your time again on a Friday afternoon. We really have a bit of a global feel to the webinar today, to the ShareCafe Hidden Web webinar, a Hidden Gems webinar. We're going to start off in Canada, back to Australia, and then across to Dublin at the end where it's about 4 a.m. So we really appreciate the times of all the managing directors and CEOs we have today, given it is different hours across the globe. Don't you love Zoom? It's great that Zoom can provide us with this access to these companies. We've got, once again, the same sort of format. It's 10 minutes with 5 minutes for Q&A. And first up, we have, and just before that, we've obviously got time for questions. So there'll be 5 minutes for questions. So please feel free to submit your questions on the green button down below your screen. First up, we have Antiris Tech, ASX code AVR. It has a market cap of around $35 million. We have with us today Wayne Patterson, is the CEO of the structural heart company, as I said, Antiris Technologies. The company's core technology is ADAPT, the tissue treatment technology on which their structural heart products are built. Initially commercialized to treat heart defects. ADAPT is the only engineered tissue with clinical data to support 10 years of anti-calcification and has already been used in over 20,000 patients. Wayne, you're online. Over to you. Thank you.
Thanks, Tim, and thanks for having me, and good afternoon, everybody who's tuned in. Today, I want to tell you about Antiris and what we do. Antiris is in the business of making the world's most durable heart valves. So that's a big claim. I'm going to hopefully tell you why that claim is valid and why it's important. Next slide, please. Thank you. So Antiris is a structural heart company. What that means is we make products that are used in treatment of heart disorders, cardiac disorders, and it's solving critical issues there. We're competing in a potential market space that will be worth about $8 billion US by 2025. It's about 4.5 at the moment, growing significantly, about 16% compound annual growth rate. We have two key assets that are unique to Antiris and that nobody else has. One is ADAPT, which is a treatment of the material that we build our valves out of. Now, ADAPT is very unique with a lot of data behind it, and I'll talk a little bit about that in a minute. But we have 20,000 patients who have ADAPT products inside of them globally, so it's, of course, not experimental. And our second asset is called DuraVar. You'll note the AVR, it stands for aortic valve replacement. It's also the same as our ticker. Now, the DuraVar valve is built with ADAPT, which is a treated collagen, but it's also novel in its own right. It's a single-piece 3D molded valve, and it's the only valve of that kind in the marketplace. So both the valve has unique properties of its own, and it's made up of material that has unique properties. But I'd like to talk about that. Next slide, please. So what are these valves and how are they used? Transfemoral aortic valve replacement, or TAVR, is the procedure that we are very much focused on. Now, when you have a valve or a condition called aortic stenosis, your native valve calcifies, it has to be replaced, it stops working. There are two ways to do that. If you look at the bottom right, you'll see a picture, a graphic there of a patient with their chest open. So previously they would open somebody's chest, put their heart on bypass and replace that valve. It's a very long procedure and the recovery time is significant. Typically also patients at high risk, elderly patients are not good candidates for this kind of surgery as the mortality rate is very high. Several years ago, there was a technique invented that basically replaced, to some extent, opening up the chest by putting the valve on a catheter, inserting that in the femoral artery, which is down near your groin, driving it up over the aorta and dropping that valve in place at the top of the annulus. And that procedure is called TAVR. We make valves for that procedure. Next slide, please. As I said, the marketplace is growing at about 16% and worth about $8 billion by 2025. And there's a really important reason why it's growing so quickly, which I'd like to show. Next slide, please. So one of the problems right now, of course, is that patients who need a valve replacement due to aortic stenosis get replacement valves. Now, there are a couple of valves in the market. The picture you see here is one of the market-leading valves. That's a replacement valve. What you'll note there is that valve is full of calcium. So these valves that are going in are calcifying again, which means the replacement valve needs to be replaced. What happened recently is that the FDA approved the use of these valves in what's called low-risk patients. Now, low-risk patients are younger patients. Now, that approval was only last year. That means with younger patients getting these valves, the valves have to last longer. They have to be more durable. Not only should they not calcify, but they also should not wear out mechanically. Next slide, please. You can see this graphic here. Typically, patients who are getting a TAVR valve for procedure, and they're about 85 years old, the so-called high-risk category, up until very recently. So those patients may be at 85. If that valve goes another 5 years, patients generally getting to 90 probably not go much further than 90. They die of other causes. So the valves were doing okay. But as now the FDA has approved it in younger patients, valves will go into patients who can be in their 70s or even 60s. So those valves now have to last 10, 15, or even 20 years, the life of the patient. The current valves in the market do not have the longevity or the data to show that they last that long. Next slide, please. Next slide, please. So ADAPT is the treatment material, the material we use to make our valves. It's been used in about 20,000 patients globally. But uniquely, we're the only company in the world that has shown that our material does not calcify in humans over a 10-year period of time with a very large data set. Nobody else has that data. So it's really important to note the uniqueness of that. Next slide, please. And next. Now, one of the key issues to note is that beyond calcification, there are other things going on with the valves that make them wear out. The picture in the middle you see here is another valve from another company in the space. And again, it's a replacement valve. Again, you'll note the calcium buildup in that valve. So these replacement valves are not lasting. There are 4 key areas that we address that affect calcification in these valves. Number one, on the bottom left, these valves are shipped in a chemical called glutaraldehyde. Glutaraldehyde keeps it sterile, but it's also highly toxic. So when the valve comes out in the OR, the valve is rinsed and most of the GA is rinsed off of that valve. However, it's well known that there is residual GA remains on that valve. Now that residual glutaraldehyde causes inflammatory responses, which leads to calcification. That's point number one. The DuraVar valve has no residual glutaraldehyde. We're the only one that doesn't. Point number two, probably the most important from where I sit, these valves are made up of collagen that comes from animals, bovine and porcine. And the reason they use the collagen is it has the physical characteristics that is desirable in a valve. However, it comes with downsides. The collagen coming from animals has DNA in there that's foreign to your body. So your body will try and reject that DNA. The current valves have remnant DNA on them when they're placed, and that causes an immunological response, which leads to inflammation and calcification. DuraVar is the only valve that has 0 remnant DNA in the scaffold. So that's quite an important one. If you go to the far right, the other one is the physical design and the mechanics of the valve. All of the valves in the market at the moment are made up of 3 pieces of tissue sewn together. DuraVar is the only valve that's made up of a single piece 3D molded design. It's much more anatomically correct. But what we've found is it has about 35% less wear and tear on the leaflets. Now, this is outside of the calcium part. It just wears out more slowly. And importantly, it has a bigger opening area. So it seems to be hemodynamically superior to what's in the market as well. I'll show you that information in a minute. Bottom right, point number 4. These valves are sewn together into a frame, the bits of tissue of the competitor valves. And anywhere between 300 and 800 sutures are used, and it's done by hand. Now, those sutures act as a point of calcium binding, which is the first point. Secondly, they add significantly to the cost of goods and therefore the margin. DuraVar, because it's a 3D single-piece valve, does not need that many sutures, has about 20 or 30, which leads to a lower cost of goods, but more importantly, much less binding sites for the calcium. Now, if you could address 1 or 2 of these points, you would have already a step in the right direction for a more durable valve in the market. We actually address all 4 of those where nobody else addresses any of them. So that's quite important to note. Next slide, please. One of the ways we test whether our valves wear and tear outside of the calcium environment is to put them on a machine called a cycle tester. This machine pushes fluid through the valve very quickly and accelerates the aging of the valve. Every company has these. We test our valves on them. And it allows us to move a valve much more quickly to an age point that we can measure the wear and tear. You can look at this one here. It's one of our valves, DuraVar at day 1 at 400 million cycles, which is about 8 or 9 years. About 2 weekends ago, we ran some valves past about 500 million cycles, which is about 12 or 13 years of normal use. It's obviously accelerated. It takes about 7 or 8 months to get them to that point. Now, there is a magic number here. The FDA requires that your valves must last at least 200 million cycles in order to get approval. We've tested competitor valves. Many of them fail at about 150, by the way, so it's an interesting number. The bottom number there, you see those 2.27 centimeters squared. That relates to the opening orifice, the EOA. Really important number. That measures how far the valve opens. Now, as valves get older and deteriorate, that hole gets smaller, less blood flow until finally you have to replace the valve. The DuraValve valve, because it shows zero wear and tear at 12 to 13 years, that EOA stays pretty much the same, which is really important in terms of the clinical benefits and outcomes. Next slide, please. Here's one you can see. I don't know if you can see that video there. That's a valve. I think it looks pretty slow there. It doesn't actually go like that, but that's a valve in a cycle tester. When you're a physician looking at that, you get very excited. That valve is showing how a single piece valve actually works. The graphic on the bottom left is not anatomically correct, but it gives you some idea that the Anteris valve rolls rather than slaps. And that's why we think it wears out more slowly. The design is actually far better than the current valves in the market. Next slide, please. Of course, we've gone into humans, and what you see there in that graphic is the echo from patient number 1. That's a DuraValve valve. It looks beautiful the way it's working there. Now, there are many more patients we need to get. We just had patient 3 leave the hospital yesterday, I found out, but this trial is happening in Europe. Now, what I did ask the hospital who's doing this study to do for me is to give me some numbers so I could compare to patients who were getting these valves in that hospital, and they were using commercial valves versus our patient number 1 who had a DuraValve valve. And the 3 things you measure to be able to check the viability of a valve is the peak gradient, mean gradient, and the EOA, the opening area. As you can see there, the peak gradient for the average of 1,400 patients with commercial valves was about 23. Our patient number 1 was 11. Mean gradient was 11. Our patient was mean gradient of 5. That's almost normal. So that's pretty amazing number. The EOA typically for a commercial valve is 1.5 to 1.9. Bigger is better. Ours is 2.9. That's really very impressive. It gives much better blood flow. Our patient who left hospital yesterday came out with an EOA of 3. So this data keeps replicating itself as we move forward. Next slide, please. So we are building the world's most durable valve by marrying the tissue science adapt with this incredible single piece 3D design. Next slide, please. Next slide, please. Next slide, please. 2020, obviously everyone's struggling with COVID and the impact on their business. We have had a fairly minimal impact. The biggest concern I had was doing the first in-human study, obviously in a hospital, because hospitals were very constrained. Fortunately, we were able to get that study started, which was really important. Later in the year, we'll be doing a TAVR preclinical study with DuraValve. We've started an anti-calcification study against one of the market-leading brands to show our superiority. And as a structural heart company, we're actually working on another project with ADAPT. It's a platform technology for the use in coronary artery bypass grafting, or CABG for short. There are no viable alternatives for CABG procedures right now. They strip a saphenous vein out of your leg. Apparently, it's quite painful, and they use that to bypass the coronary arteries that are obstructed. The ADAPT technology works very well. We are right now adapting some conduits, and we will be starting an animal study later in the year to test this product in the area of coronary artery bypass graft. There are about 500 million procedures per year in the States, so that's quite a big market as well. More on that to come. Next slide, please. We've got a lot of IP. We've submitted 18 applications this year. More to come by the end of the year. We probably will have done twice the number of IP submissions than what we did last year. Next slide, please. And we're really supported by a really great group of doctors in our advisory board. They've been with us for about 1.5 years. We meet about every 3 months. These doctors are top of the tree in terms of TAVR in the world and come from some of the biggest centers in the States here. They're all very well published. They're all very well known. If I look at Dr. Kapadia there, he is the director at Cleveland Clinic. It's one of the biggest cardiac centers in the world. Professor Reardon, Mike Reardon there, was the principal investigator of the low-risk study that led to that FDA approval I mentioned, as with Professor Popma from Boston. All of these doctors are very well known, very well published. They're on the podiums. They work with us and help design the valve and the catheter. So in the hands of these users, we have a captive audience once we come to market. I should also add, we're supported by a significant fund in the US who is headed up by a physician as well, who's originally a physician, and supports the company a lot. So the science is resonating. It's not only validated by all the research and studies we have, but it's also validated, of course, by the experts out in the field. Next slide, please. So I'll park it there. We are developing the world's most durable heart valve. I said it was a big claim at the beginning. Hopefully I've been able very quickly validate that and tell you why it's important. But we've got the right science. The ADAPT technology is unique. Nobody has what we have, which is 10 years of data in humans showing zero calcification. We have the right design. Nobody has a 3D single piece valve in the market at the moment. Not only is it wearing out more slowly, much more slowly in fact, but it seems to have clinical benefits as the EOA is far better than what's in the market. So hopefully that'll keep repeating in the study. And it's the right time. The FDA have approved the use of TAVR in low-risk patients, which means younger. Therefore, the need for a much more durable valve is upon us right now, and the market wasn't quite prepared for that. I'll conclude my presentation there and go back to you, Tim.
Great, thank you for that, Wayne. A couple of questions. In regards to a product like this, how do you distribute it to the market?
So we'll come to market with a partnership. We are in discussion with several of the big companies here. They're all based in Minneapolis, actually. The global headquarters for the big device companies are here in Minnesota, which is helpful. So, you know, typically you get from where we are in the clinical stage, we'll be submitting to the FDA for our EFS study next year, 2021, also to the Europeans. That's the beginning of the process to get registration. And we would go to market on a commercial basis with a couple of the companies who are already in the space right now, who are looking for their next generation TAVR devices to make sure they can maintain market share.
And so what's the like the business model here, the addressable market, the margin? How do you make a dollar?
We make a lot of them. The average selling price of one of these devices is $35,000 US dollars. And the cost of goods is probably confidential, so I'll leave that there. There's very good margins on these. There are only two real players in the market, and as I showed earlier, it's growing at about 16% compounded, up to about $8 billion by 2025, and it'll go beyond that, and that's without China in the mix, who are just coming online with these products. So really with two market players, there's, you know, roughly split 50-50. The chances that a product like DurAVR will get into the market is very high. We've got the support of those doctors. We've got the support of the big companies as well. So we would go in there on a licensing royalties kind of deal once we get through the registration process. Okay, great. Wayne, thank you for your time. And we'll leave the US now and head to Canada. Next up, we're going to talk oil and gas with Michael Dobovic, who is the Canadian country head of Kalima. Kalima is investing in oil and gas exploration and production projects internationally. The company owns 100% interest in more than 60,000 acres of drilling and production rights in the Montney Formation in British Columbia, Canada. The Montney Formation is one of the top ranked resource plays in North America. The stock has a market cap of around 11 million and an ASX code of CE1. Over to you. Thank you, Michael.
Thanks for that, Tim. Quite an interesting presentation to follow. Given the North American diet we have, I might want to keep in contact when the studies come. So right on. Thanks for everybody that's on the line. So next slide, please. So the Kalima story begins really back in 2014, but became active in 2017. Kalima farmed in on some acreage up in Northeast BC back in 2017. 2018, they did a deal with the partnership to take over the partner that puts us into the 100% ownership position. And back in the winter of 2018, 2019, we went out and drilled 3 wells up in the Montney Formation up in Northeast BC. The first well that we drilled was a vertical well where we were able to take a big core section of the Montney, about 240 meters of core, so quite a substantial thickness to the formation there. We were able to take that out and do a pile of research on it. The next 2 wells were horizontal wells with a 2,500 meter horizontal leg in each of those wells. One was an upper Montney, the other was a lower Montney. So we were able to get those wells in, drilled, completed, fairly intensive frac completion, 92 stage completion, so quite a heavy completion on these wells. And we were able to get a solid resource report out of McDaniels, who's our resource analyst here in Canada. That resource update came in the middle of last year, and we're working on some updates there. The biggest news as of recent is in the first half of 2020, we announced that we had closed on the Tommy Lakes infrastructure, and we formally closed on that here the 15th of April. So what that infrastructure does is it allows us to be development ready. We have permits in place with the regulator up in Northeast BC that allows us to tie in by pipeline the Montney acreage, the Montney position that we have, the wells that we've drilled, and put them into the Tommy Lakes infrastructure, which we now own and operate. And that puts us into the sales gas line, which would take us out and distribute us to the rest of North America. So it gives us puts us into an interesting position where we are development ready. We're in a position to seek partnerships and other opportunities to determine how we ultimately want to develop this acreage and what the partnership towards production looks like and what the timeline of that looks like. So next slide, please. As I mentioned, the Kalima story started a little bit earlier than 2017 with the management team having a bit of a geological background. They were looking at this Montney acreage, doing some predictive modeling back in 2014 and earlier that enabled them to get in and assemble an acreage position quite early on. And they were able to assemble that acreage position at a relatively low cost. So that position allowed us to go out and drill the wells the following year. So we were able to prove through the drill bit the two main things we were after. One is this liquids rich gas, which we found it was, and two was the gas overpressured, and we were able to prove that. So we were able to do that. We executed with a really small team up here in Canada, some strategic partnerships with some consultant agencies here, and allowed us to come up with that solid resource report. And then we've continued to move forward with getting our project development ready. So we're in that position now, permits in place, ready for a funding partner that would enable us to get these wells on production and get this gas flowing and liquids flowing to market. Canada, as we like to think of ourselves as a leader in environmental performance, a country that has a high ESG rating. And then the other piece here is our investment, our executive team is well invested into this project, significant shareholders. The directors are taking fees in shares rather than cash to help us maintain our cash balance. And the rest of the team here, we're taking a portion of our salaries in shares as well. So we're heavily invested, as well as during the last rights issue, the management team heavily invested into that as well. So next slide. So here we are up in Northeast BC. Kalima sits on 63,000 plus acres of Montney rights, Northeast BC. The McDaniels report I mentioned earlier, the reserve report, showed that we had around, we had 1.176 T's of gas up in Northeast BC. So a significant reserve report that we were able to pull together after the success of our wells, the drilling and testing of our wells. The other interesting thing is we were able to convert about 60% of our core acreage to long-term leases. So when you originally acquire the drilling rights to these areas, you have a certain window of time. You've got to go in and drill them. And then if you drill wells based upon the depth and length, then you convert the acreage to a longer holding position. So about 60% of that acreage, we have a 10-year tenure on it. So up until 2029. So some good timeline in front of us there. The wells that we drilled and tested, as it shows there, top quartile wells. The wells we were able to book reserves around 8 BCF of gas for these wells, which in comparison to some of the similar wells that were coming in at that time frame were in that 5.5 BCF. So a significant increase in what the industry was seeing for recoverables there. One of the other interesting things to point out on the map is some of the neighbors we have up there. Tourmaline, Black Swan, and Petronas are some of the larger gas operators in Western Canada. Look at them to be some of the aggregators that are going to put some of these acreage positions together. Obviously, Petronas, one of the larger ones on the map, is also a significant partner in the LNG Canada facility that is being developed on the west coast of Canada. So we're in good company up there. Next slide, please. So this is a quick snapshot of the Tommy Lakes infrastructure that I mentioned earlier. So When we first set out to drill the wells and look at where we were going to tie in this production, the Tommy Lakes infrastructure was the natural fit. We were working with the previous operator, negotiating tie-in agreements and so on and so forth. And then they made the decision to shut in their wells that were tied into this field. And so that gave Kallima the opportunity to take over a little over 30 kilometers of pipeline. We secured 3 compressor sites and a campsite to enable the workforce up there. So pretty strategic acquisition. We picked it up for really good price. We essentially picked it up for the liability associated with it. The replacement value of this infrastructure is around $85 million. So it's a sizable investment that we were able to get into our name. The field was put to bed last winter and preserved accordingly. It's laid up for us, ready to initiate the development and turn this field on. So we're, with the permits we have in place, we're about a 6-month turnaround to be able to get this well, these wells onto production. And the infrastructure we've acquired it was built at a nameplate of 50 million a day, so lots of access for capacity increase there. And then the other interesting thing to note is the tie into the North River midstream infrastructure. So that's a 12-inch sales gas line, lots of capacity into that line, and that ties us into the remainder of the North American infrastructure. Next slide, please. So Canada admittedly struggled over the last few years on the oil and gas side. We were struggling to get pipelines built in our country. Access to additional markets was a struggle. We were able to get the strong backing of our provincial and federal governments for 2 key oil sands pipelines, the Keystone XL and the Trans Mountain Pipeline. Those pipelines were backstopped financially by both the provincial and federal government, and they're both under construction now. So we're seeing some good development going there. The LNG side of things, we were a little slow out of the gate on LNG development, but we now have LNG Canada building on the west coast of Canada, a sizable facility. We're already looking at what would it be to be the second, to develop the second train of that facility, or second phase of development. And Woodside, Chevron, looking at their Kitimat facility, looking to bring that on stream shortly after the LNG. So waiting on some additional decisions there, but we are seeing development on both the pipeline side as well as the export side. One of the other interesting things we've seen as of recent is a strengthening in our gas price, and that's been due to a number of things. Investment into the infrastructure here is one piece, but more recently what we're starting to see is the decline in the oil production out of the Permian, and the side effect of that is the associated gas. The reduction in that is helping to support and bolster the North American gas prices. With the reduction in oil, we're also seeing the reduction in the increase in the gas price and reduction in overall gas availability. Next slide, please. So the benchmark pricing for gas in Western Canada, we refer to the AECO strip or the AECO hub. And what we've seen year over year, last year to this year, is a $1 increase in the strip pricing, the forward-looking price on that. So that's quite positive. The other nice thing that we've seen is the parity between AECO and Station 2. So Station 2 is the hub that the majority or a lot of the gas in BC is allocated through. And typically the historical differential has been significant between AECO and Station 2. Station 2 trading at a lower differential, and that those two prices have been essentially at parity for the last number of months, and we're continuing to see strength in those numbers. Next slide, please. So what's next for us? We have that Montney, the Tommy Lakes acreage and, the Montney acreage and the Tommy Lakes infrastructure. So we're looking at the opportunities that exist there. We're revisiting our reserve report with McDaniels, looking at full field development models and what the different scenarios look like there, and where the best opportunities for operating the Tommy Lakes infrastructure are. Now that we own that infrastructure, we can look at the best ways to utilize the existing pipes and the existing facilities that are there to maximize our Montney production, but also to reduce our costs. We're looking at some cost savings to bring these Montney wells onto production. The original scoping we had add there was about a 20-kilometer pipeline, and the cost of that is in the $25 million range for the pipeline and facility. So we're looking, we're very excited at the opportunities for cost saving there. On the new venture side of things, we're continuing to meet with partners here in potential partners in Calgary and abroad. The opportunity in the mergers and acquisition space is high here in Canada. We're starting to see some activity of those aggregators that I mentioned before. And with LNG Canada coming on, we're also looking at those partnerships to be able to provide those molecules into that facility with some of the other investors that are in there. On the cash side of things, Kalima has a good working position right now, good capital position. It allows us to be patient and make good decisions over the course of the next 18 to 24 months and allow us to develop this at the right time and on our schedule. Next slide, please. This is just a quick overview of the management team. Myself and Aaron sit up here in Canada. The rest of the management team's down there in Australia. Next slide, please. And this will be the last one I'll leave you with. So we do have some time here for a Q&A, so hopefully we get a few good questions out of that. And with that, if you feel free to reach out to any of us on the slide deck here or follow us on any of the social media outlets that exist.
Thanks, Michael. Appreciate your time. I mean, oil and gas has been in the perfect storm with, you know, COVID and obviously the oil price. What does it look like moving forward for funding and partnerships for Kalima?
Well, we take a positive look on everything these days. The LNG side of things, the gas markets are still continuing to be strong. We're seeing some strength back in the oil market already. We're looking at our opportunity here to be development ready. We sit here with essentially no debt. We're in a good cash position and ready to act on the development of this acreage. So I'm positive with what we're seeing in the market and positive that investment's going to return into the space. We've seen some runs on gas producers here in the last little while, and the Canadian gas space, through the crash, those companies weren't as heavily affected, weren't affected nearly as much as the oil-weighted companies. So we're positive on that front.
Great. And when you talk about kind of turning off an oil field, what does that physically mean? Is there a cost to that to bring that back online?
There's a cost to shutting in the oil fields, and then there's obviously a cost to bringing them back on. On the Canadian front, the oil sands fields, they have a much harder time bringing them back on. They're a thermal field, so there's lost energy. When you shut those fields in, that energy dissipates and they have to put more energy in to warm that oil to bring it back on. And then the Permian stuff is big capital cycle, and so the capital cycle continues on those to maintain that production and to bring them back on.
Okay, great, and thank you for your time. We know it's getting late there in Canada, so we really appreciate it. Thanks, Michael.
Thanks for your time, Tim.
Okay, next up we have Xantippe Resources. We have Richard Henning, the Managing Director. The company focuses on precious metals in the renowned gold producing region of Southern Cross in Western Australia. Richard is both a mining executive and a geologist with more than 40 years experience across a wide range of countries and commodities. So Richard, thank you for your time. We're back in Australia, and over to you.
Thanks, Tim, and thanks to the guys at Chapter One for organising this opportunity. I'll not take too long over this presentation. I tend to move through fairly quickly, so I'm more than happy to have any questions at the end of it. So very quickly, our summary. We've moved into this space just in the last few months. We recognized Southern Cross as one of the most renowned areas for gold mining and gold exploration in Australia, particularly in Western Australia, with more than 15 million ounces already known in the Greenstone Belt. I'll go on to talk a little bit about the drilling as we go through the presentation. But I think the focus really for Xantippe is going to be on gold for the near future. Just a little bit of background to the company. 6 months ago, we were Peninsula Mines. We had a very strong presence in Korea, in South Korea, looking both at graphite and at base metal opportunities. We still hold those positions in Korea. But about 6 months ago, we had the opportunity of, presented to us by Greg Connell and one of the local prospectors in the Southern Cross area, a chap called Vern Strange. And they've spent the last 2 years putting together these 22 contiguous tenements. And they presented us with the opportunity of buying an option to look at those and develop the area. Now, we believe that's a very exciting prospect. And to the fact that Greg has retained significant ownership of the company, some 13%, and is also a director on the board, I think gives us a great deal of insight to the local area, and with local logistics support, we can move very quickly. Next slide, Colin. Okay, so we are about 400 kilometers east of Perth. It's no more than a 4-hour drive across very good highway. The belt itself is well known. We have a number of tenements, particularly to our north and south. Edna May is about 40 kilometers to our west, Marvel Loch, immediately at the south tip of our northern tenements. Significance of these mines is that they have also got processing opportunities, processing plants. So when we have a resource that we can actually mine, processing should be a very easy option to us in terms of proximity and good neighbours. Project area itself, we have sealed roads, we have power, we have water, railroads, the town amenities. Again, we have local guys in the area. So we already have our mining logistics and infrastructure set up for any time that we need it. And again, that allows us to move very quickly. Next slide. So the neighborhood is good. Nearology is a word which is often overused in prospecting, but we have Fraser's Mine to the north, Axe Handle right in the middle of where we are, and of course, Marvel Loch to the south. And the outline you can see there are our 22 contiguous tenements that run immediately from Southern Cross along strike all the way down to Marvel Loch. We also have tenements further south of that, but our first concentrated effort will be on these tenements. Next slide. So I have a number of high priority targets. Our maiden drilling program we completed in March. To give you, again, some idea of how quickly we can move and how drill ready these targets are, we had our final shareholder approval to acquire these assets at the end of January. We submitted a program of works in February to the Department of Mines. We were on site in March, and by the third week in March, we had completed 16 RC holes. The results showed that we were in the right place. We were able to replicate the broad mineralized zones that we knew were there along those particular strikes. And as a result of that, we're continuing to drill. We have 3 targets which are historically very strong, but as I will again go to mention that we're doing a lot more research at this point to make sure that we have the accurate target. But this particular slide, I just draw your attention to the little yellow dots that are all around us. Those are known gold occurrences already in the area. So there can be no doubt that we are in a very prospective exploration zone. Next slide. Okay, a little bit about where we drilled previously. The company is called Xantippe after one of the prospective areas that I particularly like, Xantippe and Treasury South. We're just north of Marvel Loch, which is one of the most productive gold mines in the area historically. It has been run in the past, and a number of companies have run that in the past, presently owned by a Chinese company. But in terms of our location, We are just literally on the northern boundary of Marvel Loch. We like the look of the shear zone, which exists on that northwest-southeast trend line, and we will focus on the Xantippe and Treasury South area. Historical drill results have been quite remarkable. That's one of the things that attracted us to this opportunity in the first place. And if we can replicate any of those results in the near future, then we will have some terrific targets and hopefully build a quite significant resource. Notably that a lot of the drilling in the past has been very shallow. A lot of it has even been auger drilling, just to 3 or 6 meters. No drilling is being done below 100 meters, and that certainly is going to be one of our targets, not only to replicate the mineralized zones that we know are there, but to go deeper and find more targets that haven't been drilled previously. Next slide. Glendower is kind of midway between Southern Cross and Marvel Loch. Again, historical drilling results have been very attractive. 9 meters at 20 grams per ton is really quite significant. Again, no drilling below 100 meters. We have identified the zones. That's a photograph of some of the drilling that we did in March. And it will be our intention now to look at drilling further east and west on that trend line at Glendower to validate further results that we have received to date. Next slide. So where do we go from here? Phase 1 was completed in April. We did hit the targets that we were intending to hit. But for the next phase, we will be a little bit more research oriented. I think it's fair to say we have a historical database from a number of previous drilling companies that have been published by the Department of Mines. We have a high-level data review underway, in fact, almost complete of that data set, so that we have a much more consistent view of historical drilling. And we intend to merge that with ground magnetic surveys. Airborne is available to us. We have now completed the acquisition of all of that data set, and the review is currently underway in terms of what that information gives us, where we believe the best zones for drilling will be. They may not be where we thought they were because of the historical drilling results, but it will certainly give us a much better picture in terms of where we should drill next and where we will get the best results for our future resource definition, and hopefully get to mining in a very early stage. Phase 3 will be the drilling of those prospective targets, and we should be able to produce a program of works later this month, and hopefully be drilling by the end of July, certainly early August. Next slide. So a bit of a review of the company. So we've changed our name to emphasize our work in Southern Cross. We still maintain our assets in Korea. They are, I believe, of value. Mostly graphite, with also some zinc and base metal opportunities too. We will probably look to joint venture or divest those opportunities. We will keep an interest in them because, again, as I said, there is value there that we have invested in the past. But it's particularly with travel restrictions at the moment, it is difficult to keep a real handle on what is in Korea. And our compelling view now is that the company will get better and quicker results by focusing on the gold exploration program in Southern Cross, while trying to be patient in terms of identifying the value partners that we will seek in Korea. The drilling program is active and will be ongoing, and that certainly, with the geophysics that we have, will be give us a much more accurate picture of what we continue to drill. Next slide. Quick overview of our board. Philip Jackson, very experienced in legals. Tim has given you a little bit of background to myself. Greg Hunnold, a very important member of the board now, as he does have a lot of knowledge in the area and has been a geologist of some repute in that gold greenstone shear zone. Young Yu, very experienced in Korea. In fact, he was our key man, and remains our key man in terms of what we will do with our Korean resource and the partners that we will seek. It is our intention that we will probably look for Korean partners rather than anywhere else in the world, because we believe that that is probably the best way, again, to retain the value and keep our projects there with some value-added intent. Next slide. So really, in conclusion, and this slide is 24 hours old, in that we have just completed a capital raise. We didn't. It wasn't necessary, but it was an opportunity to get our balance sheet back, or our cash asset back, so that we can complete the next 12 months of drilling. If we want to extend that, we can do that with what we now have available. We currently have a cash of $2 million. We have issued some 600 million shares to do that. And with that, we have brought a few more committed shareholders onto our balance sheet and onto our share register. So we're well funded. We have a very clear picture of where we want to drill in the future, and that is Xantippe. Thank you for your attendance. Tim.
Thank you, Richard. How does an opportunity come to you in this space, considering it comes from kind of a prospector? How did it come about?
Well, look, we're very lucky in that the prospector, as it were, has been an MD of an ASX listed company in the past. He knows his strengths, and his strengths are identifying areas rather than exploiting them and exploring them. So he saw an opportunity to stay connected with the prospects that he had, to bring in a partner by the name of Greg Hunnell to help develop that. And we were extremely fortunate to be in the right place when Greg offered them to us at a price which we thought was very attractive.
And is the opportunity here now in the gold space because of the gold price, and that's where you see the opportunity is?
Look, without doubt, Tim, the gold price and the flavour that sits within the gold industry at the moment made our capital raising last week a much easier prospect, which is one of the reasons why we went to the market. We were originally seeking 1 million. We actually got subscribed to over 3 million, so there's a lot of paring back. Without doubt, I mean, we still don't have a resource. We have a lot of work to do. Our forward projections are that the gold price is going to stay strong for some time. We know that the processing plants nearby have got capacity to work with us. So within a 12 to 24 month time frame, we should be in an opportunity to actually really capitalize on the strong gold market that exists.
And in the space where you are now, Southern Cross, I think, are the big boys been playing around there in the past?
Oh, the big boys have certainly been there. Sons of Gwali were there for many years. St. Barbara were there. Minjar, the Chinese company, is a state-owned Chinese company. They are extremely busy at this point. There are opportunities still for further acquisition in the area, which we will look at. And of course, Ramelius, who own Edna May, are still very active in the area too. So we're in very good company.
Okay, Richard. Well, thank you for that presentation, and good luck with your prospects moving forward.
Thank you, Tim.
Right, next up we have James Fitter. He is the passionate CEO of OneView Holdings, and he's coming to us, OneView Healthcare, my correction. He's coming to us from Dublin, so we appreciate that it is early morning there. I believe it's around 4 a.m. Now, OneView Healthcare is a global leader in healthcare technology and IT solutions. With offices in Dublin, Chicago, Sydney, Melbourne, and Dubai, OneView develops innovative, feature-rich patient engagement platforms for hospitals, aged care facilities, and other healthcare providers to create technology solutions that drive cost efficiencies, improve outcomes, and enhance patient care. James, we really appreciate the time you've given the time over there. So over to you now, and then we'll go from there.
Delighted. Thanks, Tim. Can you hear me okay?
Yeah.
Great. Well, good afternoon, everyone. Thanks very much for having me here today, and looking forward to sharing a bit of an update on where we're at as a company. So I think we can skip through the legal disclaimers, but obviously we'll won't be making any forward-looking statements at this time. So I'm assuming most of you are new to the company, so I just want to talk a little bit about our vision. And our vision really is very simple. It's to power personalized exemplary care experiences. And that really involves three key stakeholders: that the patient in a hospital setting, the patient's family, who increasingly in recent times has been isolated from visiting hospitals, and of course the care team. And what we've long learned about technology, particularly in healthcare settings, is that if we have a technology solution that's deployed in hospitals, if it's not easy for physicians and nurses to use, they simply won't use it. So it's really important that they're seen as a key stakeholder in the process. So we really look to cater to all three of those core constituents. Jump to the next slide for me there, Tim. Great. So this is what our solution looks like. And effectively what we're doing, we really are at this intersection of where healthcare and consumerism collide. This is a very typical look at what our solution looks like in a hospital setting. So what you're seeing here is a tablet that is fixed at the patient's bedside. In this case, it's actually affixed to the meal table. And that tablet really acts as the control center for the patient. And our objective is to provide personalized, contextualized, real-time information for the patient to help them get home safer, faster, better informed. And the tablet controls the television. You can see the television on the wall is a device that is mirrored. We put a little mini PC behind the TV, and it allows the patient to either be using the tablet or the television. And obviously when family members arrive, the devices can be separated, so the patient might be watching educational content on the tablet whilst the family member might be watching entertainment. But what we're really trying to do is bring together, if you hop to the next slide for me, Tim, a very disparate bunch of systems that typically don't talk to each other in hospital settings. And we rely on information that's provided to us by the electronic medical record. Would you just hop to the next slide for me there, Tim? There we go. So as the name of the company suggests, we're trying to provide one view into all these disparate systems. On the top left, you'll see the electronic health record, which is the ultimate source of truth and tells us information about the patient. So we'll know the patient's demographic, we'll know their age, their diagnosis, their primary language. We run currently in 22 different languages around the world, which is a huge satisfier for a patient when they arrive in hospital. What we're presenting is information that shows their expected length of stay. We're pushing daily goals and educational content that is specific to them, but we're also putting them in charge. And these are all the different systems that we integrate with, and this is really the core to our value proposition. One of the curses of healthcare technology is that the lack of interoperability. A lot of these systems typically don't talk to each other. So we try to bring them all together, and I'd like you to try and think of us as being like the enterprise app store at the bedside that allows a hospital to provide different tools that are going to give the patient a whole bunch of options. And if we jump to the next slide, we can talk about what some of those are. So it's really about providing convenience and control, putting the patient in control of the hospital situation. Anytime you're in hospital, it's a time of great anxiety, it's a time of uncertainty. So we're trying to help you understand, who are all these people that are coming in and out of the room. We identify the care team for you. We want to make sure that we're providing a technology platform that liberates nursing to focus on what they really want to focus on, which is caring for patients. So for example, every hospital bed in the world has a legal requirement to have a panic button. It's called a nurse call button. One of the challenges is that patients tend to push that button whether they want a glass of water or whether they think they're having a heart attack. So what the OneView platform allows us to do is to set up service requests. So if the patient simply wants a pillow or a blanket or wants to control the temperature in the room, we allow the patient to take control of that. That's a really important issue in terms of liberating nursing. Nursing is, there's a global shortage of nursing talent. It's estimated there'll be a shortage of over 1 million nurses in the United States by 2024. So anything we can do to take pressure off nursing and liberate them to do what they want to do is incredibly important. Distraction and calming is a really important part of recovery, and that means providing the kind of digital tools that patients are increasingly expected of at home, which would include things like Netflix and Spotify or iView or the SBS player in the Australian context. We want to provide those, and includes meditation content, so a huge range of content to allow them to be distracted from the pain, particularly in a pediatric setting. That's really important. Measuring and managing experience, so we want to get a sense if a patient's having a bad experience in hospital. We need to know. Hospitals both in Australia and the United States poll their patients 6 weeks after discharge. In the United States, those patients are asked 11 questions about their patient experience. Those answers are collated, and every hospital in the country is ranked from best to worst. And if the country starts to fall into the hospital starts to fall into the lowest quartile, they start to lose their federal funding for Medicare and Medicaid patients, which is a big deal. But more importantly, hospitals that are well ranked tend to attract higher occupancy in any high fixed cost business. That's a huge driver. And discharge readiness is allowing us to use the platform to help the clinician prepare the patient for discharge, which includes, of course, telehealth capabilities, which we'll talk about in a second. So the problems we're solving, as I mentioned, it's an increasingly competitive business in healthcare, particularly in the United States, where there's been massive consolidation. Consumer expectations are growing. Consumers really want to have access to the kind of tools they have in their own home. In a hospital setting, there's huge pressure on clinicians already, so anything we can do to liberate that is incredibly important. And we know from research that's been done by Accenture and others that hospitals with a superior customer experience generate 50% higher margins, and that has a lot to do with the technology savings or the efficiency savings that get driven from solutions like ours, but also from word of mouth. If patients have a fantastic experience or clinicians have a fantastic experience, they'll tend to recommend their patients attend those hospitals. Just a quick fly through some of our customers in Australia. Names will be familiar to some of you. Will be Epworth in Melbourne, where we're deployed in 8 hospitals. For them, where we've been there for 5 years. We're currently deployed across the MARTA system in Brisbane, where we're in 7 hospitals. We're at Sydney Kids at Randwick and Westmead. In Sydney, we're at Cairns Hospital in Queensland, the Chris O'Brien Lifehouse. And you'll see that we're also, obviously we'll talk about the US in a second, but we're also in the Middle East and Southeast Asia, which I think really speaks to the global nature of the problem. We're currently live in 55 hospitals across 18 different cities. And if you jump to the next slide, Tim, you can see that in the United States, we're very proud to count 3 of the top 20 hospitals in the country as customers. University of California in San Francisco is an hour from Silicon Valley. We won that business 5 years ago. When they went out to tender, they fully expected that a Silicon Valley company would win the business, and lo and behold, a small, rapidly growing Irish company won that business. And New York Langone is our most recent logo in the United States. They're one of the top 10 companies in hospitals in the country, and have been the first customer to adopt our cloud solution, which we'll talk about in a second. Our business model is very straightforward. It's a subscription-based software model where we charge the hospitals per bed per day, whether that bed is utilized or not. Our average is currently running at around just under $3 per bed per day. We have around 11,000 contracted beds globally, about 8,500 of those beds are live. They're typically 5 to 7 year contracts. Some are a little bit shorter, but we're also very proud of 100% retention rate. Hardware, we obviously deploy tablets and televisions in hospital rooms. We don't do that ourselves. We outsource that to a system integrator. But where we are providing customized hardware for our Android platform, we're also generating about 20% margins on hardware. And of course, we charge professional services for implementation and optimization. And because we take all of our employee costs below the line, that effectively translates to significant margin for the business as well. A couple of quick financial highlights. Last year, we grew our recurring revenue growth. It was 32%. We had in Australian dollar terms around about $8 million of recurring revenue. Our margins, 60% gross margin, which is a combination of the software margin, which is close to 90%, diluted somewhat by the hardware margins. We've been through a very aggressive cost management exercise in recent times, and we have a very strong healthcare pipeline of business, including 4 of the top 10 hospitals in the United States. quick couple of slides. I've only got 3 to go, and then I'll be delighted to take a few questions. Just our response to COVID. Obviously, this has been a seminal moment for the healthcare industry globally. We've seen hospitals, both in Australia and the United States, pause elective surgery, which is unsurprising given the impending crisis in Australia and the actual crisis in the US. And obviously that's put significant financial resources under pressure at hospitals. We're seeing reduced capacity, and that capacity is going to be somewhat constrained due to social distancing protocols going forward. But I think the thing that's been incredibly important for us is trying to understand how we can use the OneView platform in the room to enhance telehealth capabilities to deliver virtual care, virtual rounding, virtual translation. And that's exactly what we've done. So we've developed a cloud solution. If you jump to the next slide for me, please, Tim, which really has enhanced the value proposition for our current customers. It allows them to deploy the solution without OneView staff requiring access to the hospitals, because a number of hospitals in the United States are preventing access from vendors at the moment. But what we're able to do is, in the midst of the crisis in New York, we developed this new platform on the cloud, which allowed a clinician, a nurse, or a doctor to launch an enterprise quality video link to a patient, a high-risk patient. What that meant is it prevented the care team from having to don protective equipment to come and visit that patient. We could launch a call on Cisco Jabber, on Zoom, or on Microsoft Teams, which enabled those care teams to have a high-quality conversation with the patient without putting themselves or the patient at risk. And importantly, we extended that to visitation. So if you just jump to the next slide, Tim, to the final slide, I'll show you what this looks like. So this is the actual solution that was deployed at NYU Langone. You can see we provided educational content on COVID-19 at the bottom. When you click on these tiles, the virtual rounding allowed, in this case, Cisco's enterprise rounding system to establish the virtual communication between the care team and the patient. We integrated with a virtual interpretation service called Marty, which allows language translation to be brought to the patient's bedside. And virtual visitation was done to allow family members who sadly, as many of you will know, are prohibited from visiting during the crisis. So it provided a communication channel directly between the patient and their family members. And of course, we provided things like Netflix and Spotify for the families as well, for the patients as well. So I hope that gives you a very quick run through, and I'd be delighted to take any questions if there are any.
There are, James. I mean, there's a couple of questions. One in regards to aged care. I mean, is aged care right for this sort of platform?
Yeah, look, we've been since we became a public company in 2016, we've identified aged care as a real opportunity. We had been collaborating with a major operator in the Australian market for the last 2 years. Sadly, that collaboration came to a bit of an impasse last year, but I think you will have seen, particularly in New South Wales, and you might have seen comments from the New South Wales Premier and from Richard Colbeck, the Minister for Aged Care, saying that they really see these kind of tools as the sort of tools that would be incredibly helpful. Obviously, a very challenging time for people who have loved ones in care settings where they're prohibited from visiting. So we've actually just deployed a small number of tablets to a care facility in California who are trialing the solution. And yes, we do see very strong potential for growth in that market.
There's another question here around competitors. Who else is playing in this space in the US?
Yeah, it varies. In the United States, there's a company called Get Well Network who've been around for about 20 years. They're the market leader in the space. They're deployed in about 4%, 5% of US hospital beds. The reality is that both in the United States and Australia, we would estimate that less than 15% of hospital beds have a solution like this. The market, according to HIMSS Analytics, is still massively underpenetrated. What you tend to have, particularly in the Australian setting, is you'll have a TV rental model where historical companies would go to the hospital, they would offer to provide a television service, and in return, the hospital would allow them to charge the patient for free-to-air television. That's not a great model. It's not a great experience. And obviously the changes in the entertainment landscape mean that free-to-air television is not the value proposition it once was. So in Australia, Hills Industries is a listed company that many of your listeners will be familiar with. They bought a number of those TV rental businesses in Australia and continue to support that model in different parts of the country. And then the nurse call company, Roland, which is the largest and very well-respected nurse call company in Australia, they resell a German product from Siemens called HiMed, which we bump into occasionally in Australia as well.
And I mean, it's a massive footprint you're taking on. When do you become cash flow positive?
Yeah, look, I mean, the one thing we'd say, I think we're incredibly proud of the customers that we've brought to the table on 4 different continents. I think that speaks to the need for the solution. The one thing I think that we would all accept is that healthcare, unfortunately, moves at glacial pace. And whilst we all understand the value proposition for what we do, and our customers do as well, there is a significant inertia in healthcare decision making, and I think that just means that we've certainly cracked the early movers. The progressives have gone very quickly, and I think we all fervently believe that this is the kind of technology, particularly with what's happened with COVID. I think this could be the sort of seminal moment that helps these kind of technology platforms move from being seen as a nice to have platform to a must have platform.
Yeah, I mean, there's been lots of questions about COVID. Is that the catalyst for wider spread acceptance moving forward?
I think what it's done, Tim, is I think it's really helped. We, for example, at UCSF in California, we put video cameras in the room 5 years ago, and the clinicians really kind of struggled to understand what the use case was for those devices. And I think what this crisis has done is really helped validate why it's important to have that kind of capability in the room. I think the scope of the platform, we're built on an Android platform. What that allows, as I said, is we effectively become like the enterprise app store for the hospital. And increasingly what will happen is that different vendors, there are so many amazing healthcare IT vendors who have a single application, but the hospital doesn't want to have 3 tablets in a room. So we see that as an opportunity to leverage the relationships that we've already built and host those other platforms going forward.
Oh, I mean, I can see that. That makes a lot of sense. So we appreciate your time, James. It's a great story, and good luck establishing a global footprint.
Delighted. Thanks very much for having me.
Thank you. Okay, that's all we have time for this week. Next week, stay tuned. We're a little bit out there next week. We're looking at the psychedelic drug industry in Canada. That could be an enormous opportunity for investors moving forward. We've got some Canadian companies presenting and an industry expert. A lot of these companies are looking to become dual listed. Obviously, psychedelics are being used to treat mental health illnesses widespread across the world. So there's an opportunity there to hear a different story next week in our webinars. So thanks for your time, and see you next week.